Welcome back to Crypto Point. In today's video, we'll talk about the 5 most common crypto mistakes. Make sure to watch the whole video to know how to avoid them. Also, subscribe to our channel for more videos. Cryptocurrency is a digital payment mechanism that doesn't rely on banks for transaction verification. It's a peer-to-peer system which allows anyone to make and receive payments from anywhere. Cryptocurrency payments exist solely as digital entries to an online database identifying specific transactions rather than as tangible money carried around and exchanged within the real world. The transactions that you make with cryptocurrency funds are recorded in a public ledger. Digital wallets are used to store cryptocurrency. The moniker cryptocurrency comes from the fact that it uses encryption to verify transactions. This means that storing and sending cryptocurrency data among wallets and to public ledgers requires complex coding. Encryption's goal is to ensure security and safety. Bitcoin, the first cryptocurrency, was created in 2009 and is still the most well-known today. Much of the fascination with cryptocurrencies stems from the desire to trade for profit, with speculators driving prices high at times. Cryptocurrencies are based on the blockchain, a distributed public database that keeps track of all transactions and is updated by currency holders. Cryptocurrency units are formed through a process known as mining, which entails employing computer processing power to solve complex mathematical problems in order to earn coins. Users can also purchase the currencies from brokers, which they can then store and spend using encrypted wallets. You don't possess anything concrete if you own cryptocurrency. What you possess is a key that enables you to transfer a record or a unit of measurement from one person to the other without involvement of a trustworthy third party. The cryptocurrency market recently crossed the $3 trillion milestone for the first time, thanks to investor enthusiasm. This put the digital currency mania, which has developed as a lucrative investing tool, into perspective. Cryptocurrencies, however, come with their own set of challenges in addition to big gains. The asset is still exceedingly volatile, which deters many investors from investing in it. Given the benefits and drawbacks of cryptocurrencies, you should be wary of making the following mistakes as a crypto investor if you want to make a lot of money. 5. Not knowing the basics of market analysis. Have you ever considered, if Bitcoin is currently over $30,000 and Ethereum is about $3,000, what if ADA or XRP rise to similar levels? I can easily get a 1,000 times return in a few years if I invest today. No. As you can see, the cost is virtually immaterial in this situation. What matters is market capitalization, which is calculated by multiplying an asset's price by its supply. If you want to invest in a coin that has the potential to increase in value by 50 to 100 times or more, you should search for one with a small market cap, ideally around 10 to 20 million US. 4. Lack of proper security. Although it's not the most fascinating topic, it's really vital. Remember that cryptocurrency is unregulated and the possibilities of recovering your funds are little to none. On all social media sites, there's several bogus crypto influencer profiles. Scammers can be found on YouTube, Twitter, Telegram, and other social media platforms. There are a lot of false admin and tech support accounts in Telegram especially. They usually have some insanely good prizes or run offers that guarantee to double your crypto in minutes, etc. If they ask you to pay them your cryptocurrency, get out of there. Although it may appear straightforward, many people have lost a significant amount of money in this manner. Being your own bank has drawbacks, so keep your private key, password, and seed phrase safe. Never save them to a computer, phone, email, cloud storage, or any other device. Instead, jot down your ideas on paper and keep them somewhere secure. Ideally, also have a copy in another secure location. Consider using the Brave browser if you're using MetaMask or another similar software wallet. It provides superior security, and as an added benefit, it has some exciting features like earning modest amounts of cryptocurrency while surfing the web. Two-factor authentication, or 2FA, is required on all supported exchanges and wallets. YubiKey is another excellent tool for boosting security. If you have a lot of cryptocurrency, consider using a hardware wallet like the Ledger or Trezor. 3. Not having a plan. What is the amount of money you want to earn and how much risk are you willing to take? When do you wish to cash out or take a profit? Either to re-enter at a cheaper price point or to cash out completely. Do you plan to invest for the short or long term? All the questions above are crucial, and how you respond should be in keeping with your financial strategy. For example, it doesn't matter how much you paid for Bitcoin if you plan to hold it long term, because its value will almost certainly rise over time. If anything can be guaranteed with crypto. Sure, there are better and worse times to invest, but the only way to go when investing long term is up. A low market cap cryptocurrency, on the other hand, may offer significantly greater gains. But if you invest while the cost is too high, you might just have to wait a long time for it to recover, if it ever does. 2. investing money you cannot afford to lose. Although it should go without saying, we'll say it anyway. You should never invest more money that you can afford to potentially lose. Of course, no one ever wants to lose money, but keep in mind that cryptocurrency is incredibly volatile, and that incredible gains come with the danger of massive losses. The lesser the market capitalization, the greater the risk and volatility. When the market shifts, even safe bets like BTC or ETH can easily drop 60 to 70%. BTC peaked at about $20,000 in late 2017 before plummeting to $3,000 to $100 a year later. When the market turns, altcoins can lose up to 90% of their value, and some may never recover. At the very least, you must be willing to retain your money for 3 to 5 years and weather the storm. In the worst-case situation, you should expect to lose everything, or at least the majority of it, if something goes badly wrong. Your specific circumstances and risk tolerance will determine how much you invest and where you receive the money. But be sure you're completely aware of the hazards and have considered the worst-case situation. Will avoiding these blunders ensure that you make money? Obviously not. However, it should assist you in lowering the risk. The more we learn about cryptocurrencies and the market as a whole, the less concerned we are about price volatility. We see more possibilities and have more enjoyment as a result. We believe that now is an excellent time to get engaged with crypto. But the key is to listen, learn, evaluate, and think for yourself rather than simply following someone else's advice, including ours. 1. Buying high and selling low. This is the most common blunder and the one that'll almost certainly get you wrecked. Cryptocurrency is incredibly volatile, and significant gains come with a lot of risk. Sure, timing the market exactly when buying and selling is nearly impossible, but there are a few consistent patterns you can use to maximize your gains and lessen your losses. There are 2 common blunders that people make: FOMO, fear of missing out, and overconfidence, fear of missing out or just simply buying high. We've all been there, let's be honest. You notice a project's price soaring and want a slice of the pie. This is especially true if you've previously missed out on similar opportunities. You don't want to miss out on anything else, so you dive right in. What's more, what's going up must come down. When you invest when a project is hot, you're more likely to lose money since early investors will take their profits, and you'll have to wait a long time to draw even, much less even make any money. Furthermore, when a venture is pumping hard, it can be quite difficult to buy in, particularly if you're dealing on a decentralized exchange or DEX like Uniswap. On the Ethereum network, you could lose a lot of money in gas fees, lose money due to increasing slippage, or have stuck in unsuccessful transactions. We've all been there, and it's not very enjoyable. FUD stands for fear, uncertainty, and doubt, or selling low. Looking at your investment going further and further into the red is one of the most depressing things you can do. When a coin's value is fast declining, it can be very tempting to simply sell it to get out of the situation. The problem is, if the project is solid and neither of the foundations have altered, there's a decent chance it'll bounce back. Sure, it's nerve-wracking, but last thing you want is to sell at a loss only to watch the currency skyrocket a few days or weeks later. Keep in mind that you only lose money if you sell, else it's just a number on the screen. So, that's it for today's video. Don't forget to like and subscribe. Also, let us know in the comments if you have learned anything.